Hello, everybody. Welcome to Tuesday. The S&P 500 was down 0.65% today, the fifth day in a row that the market has been down. Good time to be out of the market like we are for the most part, other than our high capital gains positions and our legacy positions. And a good time to be inverse, so when the S&P 500 goes down, we have a piece that goes the opposite direction of that. We did add to the inverse position yesterday, buying an inverse emerging markets piece. That actually did really well today. That was up 1.6%. So we'll see how that plays out. But really what happened today was kind of fascinating. The market opened up down. We got to the lowest point of the year on the S&P 500 kind of at the beginning of the day. And then it started to rally up, which is not surprising. We keep getting down to this low and then rallying. But it was really went very well and got quite into the positive until the Bank of England announced that they were going to stop purchasing their British bonds called Gilts, on Friday. And so they'd originally had to come in and start buying those bonds. You might recall England decided to, lower their taxes and finance the differential, that they were going to get in lower tax, collections with debt. And the market didn't like that, and their bond market really started to sell off. Bank of England stepped in and started buying bonds to support that market, and they had scheduled to, stop buying those on Friday. But there were some rumors that they might continue or they might have to continue. And there was quite a bit of volatility around this announcement today. So we'll see what happens. And of course, this is why you got to be careful in this environment, because you never know what might break here, and something happens in one area and becomes kind of contagion into other areas. And pretty soon they're, kind of spreading around. So, we'll have to watch how that plays out as far as that goes. This is a really busy week. Lots of things, several meetings from Fed Reserve governors, interviews that are coming out. So we'll see how that plays out. Been kind of negative lately. So we've got the CPI inflation number coming out on Thursday. It's expected that we're going to go from 8.3% down to 8.1% on the top line inflation, but it's also expected that we're going to see an increase in core inflation when you take out food and energy, which would be a problem for the Federal Reserve because that's one of the things they really focus on. And of course, then the Federal Reserve will be meeting, on November 2nd. So this will be, the big report that comes out prior to that. Still looking quite likely that they're going to do a 3/4 point cut or increase, sorry, unless there's just some big surprise. If there's a big surprise and inflation comes in a lot lower, well, you could see the market pop on that, obviously, because that would be really good news, because it's really the main thing driving these markets right now is what's happening here. So anyway, that's what's going on today. I look forward to seeing you tomorrow. We'll see how this plays out. But again, for the most part, our portfolios are in good spot for this. We're hanging in there. It's a good time to be in kind of T-bills, ultra short-term bonds, and inverse positions. Again, we still have some exposure to the market through these high capital gains and legacy pieces, but for the most part, we've really reduced, that exposure as much as we can. So look forward to talking to you tomorrow. Thank you.